August 18th, 1913. Casino de Monte Carlo. The roulette wheel lands on black, then black again, and again. By the 10th consecutive black, a crowd has gathered. Everyone's thinking the same thing. Red has to come next. The wheel needs to balance out. People start betting heavily on red. Life savings, thousands of francs, 15 blacks, 20 blacks, 22 blacks. People are taking out loans, betting their jewelry, their homes. Because the probability of so many blacks in a row is astronomically small, so red must come next. It's not gambling anymore, it's mathematics. 26 consecutive blacks. When red finally came on the 27th spin, it was too late. Millions lost, fortunes destroyed. People had bet everything because they were certain mathematics demanded red had to come. They were wrong, and their mistake has a name, the gambler's fallacy. And before you think, I'd never be that stupid, let me show you how you make this exact same mistake with your stock portfolio, sports betting, hiring decisions, anywhere you think past events influence future probabilities when they don't. Let's start with what actually happened at that roulette table. Here's the key fact about roulette. Every spin is independent. When the ball lands on black, the wheel doesn't remember. The ball doesn't know it just landed on black. The wheel doesn't have a quota to fill or a balance to maintain. The universe doesn't care that black came up 26 times. On a European roulette wheel, there are 37 slots, 18 red, 18 black, and 1 green 0. Every single spin, the probability of landing on black is 18/37, about 48.6%. That probability doesn't change based on what happened before. After one black, the probability of the next spin being black is still 18 out of 37. After 10 blacks, the probability of the next spin being black is still 18/37. After 26 blacks, the probability of the next spin being black is still 18/37. The wheel doesn't know about the previous spins. It can't know. Each spin is a completely fresh event. But here's what the gamblers were thinking. The probability of getting 27 blacks in a row is incredibly tiny. Therefore, after seeing 26 blacks, the 27th spin must be red to keep the overall probability low. Let's do the actual math. The probability of getting black on any single spin is roughly 0.486, ignoring the green 0 for simplicity. The probability of getting black 27 times in a row is 0.486 to the power of 27 is approximately 1 in 136 million. Incredibly small, astronomically unlikely. The gamblers were right about that. But here's what they missed. That calculation only matters if you're asking the question before any spins have happened. Once 26 blacks have already occurred, that's not a probability anymore. That's history. That's done. That's a fact that already happened. The question isn't, what's the probability of 27 blacks in a row? The question is, given that 26 blacks have already happened, what's the probability that the next spin is black? And the answer to that question is 18 out of 37. Same as always. The wheel doesn't owe you anything. Past results don't influence future spins. This is what we call independence in probability theory. Two events are independent if the outcome of one doesn't affect the probability of the other. Roulette spins are independent. Coin flips are independent. Dice rolls are independent. But human brains are not wired to understand independence. We're pattern-seeking machines. We see streaks and think they must mean something. We see randomness and think it needs to correct itself. This is the gambler's fallacy. The belief that if something happens more frequently than normal during a period, it will happen less frequently in the future to balance out. Or vice versa. If something hasn't happened in a while, it's due to happen. And it costs those Monte Carlo gamblers everything. Now you might be thinking, but wait, doesn't the law of large numbers say that things do balance out over time? Doesn't it say that if you flip a coin enough times, you'll get close to 50% heads and 50% tails? Yes, but that's not what you think it means. The law of large numbers says that as your sample size increases, your observed frequency will converge toward the true probability. But it doesn't say anything about short-term corrections. Here's what the law of large numbers does say. If you flip a coin 1,000,000 times, you'll probably get close to 500,000 heads and 500,000 tails. Here's what it doesn't say. If you flip a coin 10 times and get 8 heads, the next 10 flips will compensate by giving you mostly tails. The convergence happens through accumulation of future events, not through correction of past imbalances. Let me show you how this works. Imagine you flip a coin 10 times and get 8 heads and 2 tails. You're way off from 50-50. You're at 80% heads. Now you flip 990 more times. Because the coin is fair, Those 990 flips will give you approximately 495 heads and 495 tails. Close to 50-50. Now look at your total. 8 plus 495 equals 503 heads out of 1,000 flips. That's 50.3%. Very close to 50%. Notice what happened? The percentage got closer to 50%, not because the coin corrected the imbalance by giving you fewer heads. It got closer to 50% because you added so many new flips that the early imbalance became statistically insignificant. The actual gap between heads and tails might even get bigger. You started 6 heads ahead, you might end up 8 heads ahead. But the percentage gets closer to 50% because you're dividing by a much larger number. This is what the gamblers at Monte Carlo didn't understand. Yes, over millions of spins, the casino's roulette wheel will land on red and black roughly equally. But that doesn't mean that after a streak of black, red becomes more likely on the next spin. The balancing happens through sheer volume, not through short-term corrections. And this mistake, this fundamental misunderstanding of independence and probability, is ruining your financial decisions, your sports betting, your hiring practices, and your everyday judgment right now. Let's talk about the stock market. Because the gambler's fallacy is absolutely rampant in trading and investing, you're watching a stock. It's gone up for 5 days in a row. Your brain starts screaming, "It's due for a correction, it can't keep going up. I should sell now before it drops." Or the opposite. A stock has dropped for 7 straight days. Your brain says, "It's oversold. It has to bounce back. This is the bottom. I should buy." Both of these thoughts are the gambler's fallacy in action, and both can lose you money. Stock prices aren't like roulette wheels. They're not completely random. There are underlying fundamentals, market conditions, company performance. But in the short term, day-to-day movements often behave like a random walk, especially when you don't have insider information. The fact that a stock went up yesterday doesn't make it more likely to go down today. The fact that it's gone up 5 days in a row doesn't mean a correction is due. There's actually a name for the belief that you can predict stock prices based on recent patterns: technical analysis. And while some traders swear by it, academic studies consistently show that most technical patterns have no predictive power beyond chance. When people see a chart showing a stock that's been climbing and say, "It's overbought, it has to come down," they're often committing the gambler's fallacy. They're assuming that past performance creates a pressure for reversal, when in reality, if the stock has been climbing, there might be fundamental reasons it continues to climb. Momentum can persist. Trends can continue. Past performance doesn't guarantee future results, but it also doesn't guarantee reversal. In 2000, during the dot-com bubble, countless investors kept saying the market is due for a correction after every month of gains. They sold out, expecting the inevitable balancing. The market kept going up. They missed massive gains because they thought the universe owed them a correction. When the crash finally came in 2001, it wasn't because the market was due for a correction. It was because fundamental valuations didn't support the prices. The crash happened for reasons, not because of some cosmic balancing force. On the flip side, in 2008 to 2009, after months of declining stock prices, people kept saying, "We're at the bottom. It has to bounce back." And then it kept dropping. The market doesn't care what you think is due. This isn't to say that stocks don't have mean reversion or that patterns don't exist. It's to say that the specific form of the gambler's fallacy, thinking that a streak creates pressure for reversal simply because the streak exists, is a mistake. Let's talk about sports, because this is where the gambler's fallacy manifests in one of its most famous forms: the hot hand debate. A basketball player makes 5 shots in a row. The announcer says, "She's got the hot hand. Get her the ball." The crowd goes wild. Everyone knows she's going to make the next one. Or the opposite, a player has missed their last 6 shots. The coach benches them because they're cold and need to find their rhythm. Is the hot hand real? Do players actually get hot, where they're more likely to make shots after making previous shots? Or cold, where they're more likely to miss after missing? In 1985, psychologists Thomas Gilovich, Robert Vallone, and Amos Tversky studied this question using NBA shooting data. Their conclusion: the hot hand doesn't exist. It's an illusion. They found that after making a shot, players were no more likely to make their next shot than after missing. The sequences of makes and misses looked random. The feeling of being hot was just humans seeing patterns in randomness. This finding was controversial and spawned decades of debate. More recent studies with better data have suggested there might be a very small hot hand effect, but it's much smaller than people perceive. What's actually happening is often the reverse gambler's fallacy. After a player makes several shots in a row, we expect them to keep making them. We see momentum, where there's mostly just randomness plus some small amount of skill variation. But here's where it gets interesting. The gambler's fallacy can be right for the wrong reasons. If a player makes 5 shots in a row, they might actually be more likely to make the 6th, not because the universe is continuing a pattern, but because defenders adjust. They start guarding that player more closely, which might create opportunities for other players. Or the player gets more confident and takes better shots. Or they're genuinely having a good night because they're well-rested, healthy, in rhythm. These are real causal factors, not statistical balancing. The past performance predicts the future not because of some mystical streak, but because it reveals information about current conditions. This is the key distinction. Independent events don't have memory, but reality can have persistent causes. The gambler's fallacy isn't wrong because streaks never continue. It's wrong because it assumes that randomness itself creates pressure for reversal, when in fact, truly random events remain random. Let me show you another place this shows up: hiring and evaluating people. You're interviewing candidates. You've had a string of 4 bad hires in a row. The next candidate comes in. They seem okay, not amazing, but decent. Your brain says, we're due for a good one. The odds say this one should work out. You hire them. They're mediocre. You're disappointed but not surprised. Or the opposite, you've made 3 great hires in a row. The next candidate is strong, maybe even stronger than the previous ones. But your brain says, we can't be this lucky 4 times. This is probably too good to be true. Our luck is running out. You pass on them. They go to a competitor and become a star employee. This is the gambler's fallacy in hiring. You're treating hiring outcomes like independent random events, when they're actually the result of your interview process, your judgment, your company's appeal, market conditions, and a dozen other factors. If you've had 4 bad hires, that might mean your interview process is broken. It doesn't mean you're due for a good one. If anything, without changing something, you might be likely to make a 5th bad hire. If you've made 3 great hires, that might mean you've gotten good at evaluating candidates, or your company has become attractive to top talent. You're not due for a bad hire. You might actually be on a real positive trend. The gambler's fallacy makes you think that random chance will balance out your streak. But hiring isn't random chance. It's skill plus luck. And the skill part has memory. Here's the really insidious part about the gambler's fallacy. It makes you act against evidence. When that 26th black came up at Monte Carlo, the gamblers had extremely strong evidence that this particular roulette wheel, on this particular night, was behaving strangely. Maybe it was slightly biased. Maybe the croupier was influencing it somehow. Maybe there was a physical reason blacks were coming up more. A rational observer would think, something unusual is happening here. Maybe I should bet with the pattern, not against it. But the gambler's fallacy is so strong that people bet against overwhelming observed evidence because they were certain that mathematical forces demanded a reversal. And they lost everything. This happens in poker constantly. You're playing against someone who's been getting incredible cards all night. They've won 8 hands in a row with legitimately strong hands. The gambler's fallacy says, they're due to have weak cards. I should call their next big bet. But actually, they might just be at a table position that's getting good cards. Or they might be selectively playing only strong hands. Or random variance might continue for a while longer. The fact that they've been winning doesn't make them more likely to lose the next hand. The streak itself doesn't create pressure for reversal. If anything, it might be evidence of a real underlying cause that will persist. We're pattern-seeking machines in a world where some patterns are real and some are illusions, and our brains can't always tell the difference. If this could save you from losing your fortune on a sure thing, share it. If you've ever thought something was due to happen, hit that like button. Subscribe. Because now that you know about the gambler's fallacy, you'll see it everywhere in casinos, stock markets, and sports betting. And you'll never confuse a streak with a debt the universe owes you.